All right. Thank you so much, everyone, for joining us this morning. I know we'll probably still have a few people joining, but want to get started today. Today's webinar is going to be all about real estate, and I want to call it the reality of realty. And as I was preparing for today, I was thinking it's kind of a little bit ironic to call it the reality of realty because sometimes it feels like we're living in a fantasy land that's completely detached from the rest of the world when it comes to real estate. We thought today it's such an important part of living in the Bay Area. It's such an important part of our clients' balance sheets. And frankly, given everything that's going on in the world, what we've seen in terms of home price appreciation, a lot of people have questions, how to make decisions, how to think about what's going on right now. And our goal today is to help you put those things in the context, hopefully be enlightening and give you a sense of where we are and where we might be going. So we're going to talk about a few key concepts today. And really, if I were to set the stage as to what do we really want to accomplish, number one, let's figure out where we are. Let's understand what the market looks like, what sort of things that we're seeing, what we're hearing from our colleagues. Let's figure out what's happened in the past and see if it can give us some clues as to what might happen in the future. You know, history doesn't repeat itself, but it does sometimes rhyme. So is there anything that we can learn from the past? And most importantly, given everything that's happening from rising interest rates to just kind of general downturn economically, how should you think about making decisions amongst all these factors and what sort of things are going to be most important to you? So hopefully by the end of today, you'll leave with a greater understanding of where we are, where we might be going, and what actions you might need to take in order to best position yourself for success. But I would be remiss today if I didn't begin by introducing our panelists. For those that have attended any one of our previous webinars, you will probably notice that we are one person short. So unfortunately, sometimes life happens and we want to make sure our teammates are happy, healthy. And so we appreciate all of you adjusting with us on the fly. So I am one of our panelists, Adam Govani. I will also be your moderator today. So I apologize for all of those of you that now have to listen to me talk slightly more during today's presentation. But thankfully, I'm joined by two wonderful advisors on our team. I'm joined by Aaron Zager, Senior Financial Advisor, overall excellent wealth of knowledge. And then also Mandy Pham, another one of our amazing advisors. She's got more designations than Aaron and I combined. So clearly, you know that she's doing okay. And I'm really excited. I've had the chance to work with these two people for the last few years. I've had wonderful conversations with them, had great insights from them, and I really look forward to sharing their knowledge with you today. So thank you guys for both for joining us, and I really look forward to, again, sharing your knowledge with the team. So if we're going to get started, we got to set a baseline as to where we are right now. And you read articles on housing prices are doing this or that, but we all know that the Bay Area is such a unique market, and really it's a series of markets. So to kick us off today, and Aaron, maybe you can get us started. Tell us a little bit about where we are, the trends we're seeing, price, all these things that people hear about. Tell us what's happening in the Bay Area and what you've been able to find out.
Yeah, thanks, Adam. And thanks everyone for joining us today. Mandy before this called me old, so it's only right that I start with talking about historical data and comparing that to where we are today. It's been an interesting ride in the real estate market over the last few years, to say the least. After COVID hit, inventory and demand basically went to a standstill. Afterwards, families needed to adjust to this kind of post-COVID life, and many families wanted new homes with maybe designated work office or just more space, both for personal and professional reasons. So where we are today is that sales prices as a whole are declining and inventory is increasing as a whole. But by no means does that mean that we're in a real estate buyer's market at the moment. I was speaking with one of my real estate friends the other day, and he kind of gave me the analogy of when you're speeding on the highway going 120 miles an hour and traffic suddenly slows to 90 miles per hour, it suddenly feels slow to you, but you're still going pretty darn fast. And that's kind of the real estate market that we have now. I have quite a few clients and friends who have recently purchased homes, and they have all purchased homes above listing prices with really no contingencies on the offer. From strictly a data standpoint, I'm going to use San Mateo county for a lot of the data, but it is similar to other counties, especially here in the Bay Area. From a data standpoint, 84% of homes in the San Mateo County still closed above their listing price last month, with the average overbid of 11%. That's high, but everything's relative. So the overall, the overbid price was 18% this time last year. Now it's 11. So what we're seeing is that selling price of less expensive homes in the Bay Area are being affected more by rising interest rates and kind of the downturn that we're experiencing in the stock market. Sales of higher priced homes, mainly above the $3 million range, have held up much better. But history shows that when an overheated real estate market begins to cool, the change is typically very gradual. This is the case with, I would say, most illiquid assets. If you can go to slide, the slide before this, Anne. There we are. Just looking at home appreciation, I think it puts really good context as to where we are today versus where we've been historically. If you look at historical data, at least since 1991, home prices in this county, San Mateo County, were increasing incrementally for about 20 years. Your home basically doubled in value over a 20-year period. Not a great ROI from an investment standpoint, but since 2020, you can see that home prices have skyrocketed, where the average home value increased from 1.7 million in San Mateo County all the way to 2.2 million. That's a 30% return on investment in only 2.5 years. So historically speaking, at least, we're definitely witnessing an anomaly in home prices over the last few years.
Aaron, can I ask you a question? You had mentioned
Please.
that maybe there's a little bifurcation in the market. So we maybe see average sale prices trending up a little bit. Could you maybe talk a little bit about the considerations, and forgive me if you're going to touch on this in a little bit, but maybe some of the considerations on the upper end, kind of higher priced portion of the market? And then what's the difference, if any, maybe between, I'll say, the lower price portion of the market? We know it's all relative, but are those a different set of buyers? What trends are we maybe seeing when we break it down there?
It is a different set of buyers, and I would like to hear your input as well as Bandy's. I'm experiencing it right now where my clients are buying homes right now. Some of it may be just fear of missing out on interest rates. So they're buying homes. They're taking out loans at still relatively high interest rates. And I think you're going to cover that in a little bit. But they're either taking out loans or, there's all cash, no contingency offers on homes. And those people who can pay all cash for, a $3 million plus home, they could do it before 2022. They could do it before the market downturn, and we're seeing it happen more and more today. And the time that homes are staying on the market is very low. And I was going to cover that in a different slide, but just looking historically again, homes are selling within 14 days. It's ridiculously short periods of time between when a home is listed for sale and when an offer is put in on that home. So again, homes, there's more inventory in the market, but homes are selling at a very, very short duration.
Got it. And Mandy, would you say it's maybe a similar breakdown? Almost, Aaron, as you were describing it, I was thinking about there's different considerations for maybe the all cash buyer who's maybe more dependent on assets versus a mortgage. I don't know, Mandy, how do you think about those things, kind of how the market, because everybody's in a different situation. Obviously, it's fortunate to make an all cash purchase, but how do you think about those sort of things, maybe for your clients or in the market as a whole?
Well, I think the people who, even our client in the part of purchasing like a $3, $5, $10 million home, the home actually tend to be a smaller portion of their net worth compared to the regular people like the three of us. For example, if we do purchase a home, it's likely going to be a mortgage. It's likely going to be a much significant part of our net worth. So that make it more challenging in this kind of environment compared to, say, if you purchase a $5 million home but you have a $50 million net worth, then that is actually a smaller decision relatively.
That's a really good point, Mandy. Oh, sorry, Eric, please.
Oh, no, I would just add, for many of our clients who work in high tech, they can log into Schwab, E-Trade, Morgan Stanley, and look at their unvested RSUs. And many have the perspective of, I can just pay this off sometime in the future. So let me lock in a lower rate, maybe lock in a 10-year arm at a fixed rate at a lower rate, save the money, and let's see where interest rates are at that time. And I can always prepay. I can always pay off the loan at some point in the future and save money on interest.
Aaron, I love that your planner brain is already fired up and we're getting into some, I think it's a really excellent point too, is considering it's not an all or nothing. We're in a time of rising interest rates, but I really love that thought. And I look forward to getting back to it. Aaron, you were addressing inventory levels, which I think is kind of an interesting, so maybe if we can move to the next slide and just kind of look at where we are, because right, you got to have homes on the market to be able to sell them. I think that's a key axiom of real estate. So what are we seeing in terms of trends there, and how much maybe does that feed into where prices may be going?
Yeah, so I looked at San Mateo County. I also compared it to other counties in the area, and they're very highly correlated as far as trends. In San Mateo, they've definitely increased over the past 5 months, and they continue to increase. There's obviously a seasonal component to this, where historically spring and summer are the strongest inventory and sales times of the year. But you can see we're starting to surpass comparative listing numbers from last year. So last year, active listings were basically stagnant. You look at January through February, we go from 524 to 540. There's not much of a change as far as inventory. This year, January, through February, they've more than doubled. So we're definitely seeing more homes on the market, but demand isn't cooling, which is still keeping home prices high.
Gotcha. Aaron, it almost reminds me of where we are with oil prices. You can pump more oil, but if more people want it, right, that's kind of the balancing factor. And Mandy, I don't know if you're experiencing the same thing, but when I talk to clients, at least this is somewhat anecdotal, I have at least a strong suspicion that there's still, as Aaron said, I love the analogy of going from 120 miles an hour to 90 miles an hour. Is that still what you're hearing from your clients that are buying houses? Is that the same experience where maybe there are more houses, but the dream house is only going to come on one time, right? Is that the experience you've had recently with your clients?
Well, the reality is this has been a very brutal, at least the last couple of years. The fact that you have a house get purchased like 2-3 million above the listing price is crazy. And we're slowing down, but it's maybe now it's slightly higher than the listing price. Maybe you only have to put in 10 offers as opposed to going to 20, 30 different places, going through the emotional roller coaster to get your dream home.
I don't know if you guys have seen those billboards on the side of the road. It's for a real estate company whose name I can't remember, that it says, Mark's a Bay Area home buyer. He's cried 19 times in the last 2 weeks. Yes. It's one of those things that is pretty good advertising. It hits really close to home. I just want to take a brief interlude right here because we are starting to get some questions. We will answer. We're going to have a Q&A question, but one of the questions was just a little bit of difficulty seeing the slides. We will release these. If you want a copy, please let us know. We're happy to share this with you. So happy to do that on if you're having a little trouble seeing, and we're happy to outline a little bit more. I think the trend is inventories are up, but it's not really at this point feeding into home prices. So wonderful. And then Aaron, I think you had one more kind of key point that you wanted to touch on the real estate market that I think just kind of helps us where we are right now.
Yeah, on the next slide, we're just going over average days in the market for homes. And you can see March and April, homes are not staying on the market for very long. I mean, inventory can sometimes be a misleading indicator. And I don't know about you too, but I've heard so much about higher inventory in the real estate market from every mortgage and real estate professional that I've talked to. Inventory is kind of misleading because it's just the average number of homes that are on the market on a given day. So we have higher inventory. We have homes that are also selling at a much faster pace. So if you look at April, homes were selling in 14 days. In March, they were selling even quicker. If you go all the way back to January of 2017, you can see that homes were on the market for much longer than they are currently. So I just wanted to kind of speak that point, that higher inventory, but homes are definitely selling at a quicker pace.
Yeah,
Aaron,
higher supply, but also higher demand.
Yeah, I think the thing that's striking about this to me is, although of course there's seasonality, things take a little longer to sell in January. We are coming off, this chart only goes back to 2017, but we're coming off, at least on this chart, record lows of the amount of times that, I think all of us would have agreed that it was a pretty hot market in 2017 and 2018 and 2019, but we're still really recovering from all that pandemic demand. So, Aaron, I think that's helpful. It's not just about how many homes are on the market, it's what's selling, how fast are things turning over. And it looks like what we're seeing is really extreme turnover still at this point.
It's the same thing with the stock market. It's supply and demand. That's what drives price in the real estate market as well as the stock market.
Yeah. So just to kind of put a cap on where we are, maybe I can summarize it and the two of you can tell me if you'd add or change or disagree with anything, but it seems like what we're seeing is inventory starting to rise. And again, we're looking at San Mateo County, but we've looked at the data. It's pretty consistent across multiple counties in the Bay Area. We're seeing inventory start to rise. We're still seeing homes move very quickly, though. We maybe see a little bit more weakness at the lower price point end of the market, where maybe people are more contingent on a mortgage to purchase the home versus weakness at the top point, but we're still seeing prices continue to appreciate. Is there anything that I missed or the two of you might add to that statement?
That's a very good summary, Adam.
Thank you, Mandy. I appreciate it. So anyway, I think that's just a takeaway of where we are right now. But the one thing that we know is right now is only a snapshot in time. Although this is helpful, we're only going back to 2017. And so we thought it might be helpful to zoom out and take a slightly longer term perspective. How does real estate do over different periods of time, in and out of a recession? What do those things look like and what does the data tell us? We want today to be a conversation, but it's a little bit hard to talk about historical figures and where we are in the market without at least turning to some sort of factual reference. Otherwise, it's just us talking about our opinions, which frankly, why would you come here for an hour for that? So, Aaron, if you could go maybe to the next slide. I think one thing that's very interesting, and I'll explain a little bit about what's going on here because this is a little bit busy, but what we want to look at, right, is the thing that I think is most critical is we think about things like recessions. We also think about interest rates and how do those things affect home prices. I probably stealing this from another investor. I think it's Warren Buffett, but interest rates are like gravity insofar as they tend to pull down the prices of other assets. There's a ton of different ways to think about that. It's not a linear relationship. Nothing ever is in the markets. But the way I would think about it is if I can earn more on a risk-free asset, I would expect, again, to have a slightly higher rate of return on a risky asset. It's just kind of the basic, one of the fundamental principles of, economics and also financial pricing. So what we can see here, the red line, and I do want to respect the fact that I know a couple of people have mentioned that it's a little bit hard to see and they'd love the slides afterwards. So I'll kind of walk through again what the takeaway is. We've basically been since the 1980s, we've been in a 40-year period of declining interest rates. And that's what you can see in that red line right here, if you're able to see. I know some people might be on their cell phones, but it's probably intuitive. Anyone who's lived during that period of time or any portion of that period of time has seen mortgage rates fall kind of precipitously. And the blue line, if you're able to see it, again, is San Francisco Bay Area home prices. This is taken from S&P and Case-Shiller kind of index. So just a broad look at the prices. And what's highlighted or kind of boxed in yellow are the periods where interest rates didn't really go up, but traded in a range. And what I think is interesting is, during the 1990s, which is one of the periods that we looked at, I think Aaron had kind of touched in, real estate prices were pretty flat. And that did to some extent correspond to, again, a period of slightly higher stable interest rates. That being said, especially as rates started to get cut going into the late 2000s, we saw the dot-com boom. We did experience a recession in, I think anyone who's here during that time remembers the dot-com bust. But what was actually interesting during that time is we only saw a tiny little blip in real estate prices in the Bay Area, at least. So there were really only two major times of declining prices that generally corresponded to some extent with a kind of a pause in decreasing interest rates. That was the early 90s, obviously the financial crisis. The one difference is although stocks, fell during part of those times, interest rates also fell during the 2000 kind of 2001 period, which to some extent may have helped cushion prices here by falling interest rates. But I think the most important thing is anyone who's read any sort of news is probably familiar with the idea that interest rates have gone up. That's obviously one of the things we're discussing. But we have seen a pretty substantial tick up in mortgage rates. And I know Mandy's going to talk a little bit more about that and what that means. But the one thing that we can't necessarily know is how will those mortgage rates feed into prices? Right now, we haven't necessarily seen it as much, although maybe we see it at the lower end. But one thing that I think is important is it does take a little while for these things to feed into prices. So I don't know, Mandy, Aaron, do you think that's a fair, that there's maybe two things, and we had talked about this in our two, I think about it as kind of like financial assets are one thing that maybe is used to purchase a home, and then interest rates being the other factor. I don't know, does that vibe with your experience, and am I missing something there by any chance?
Yeah, and coming back to Aaron's comment earlier about, say, Facebook or a Meta employee log into their stock company and see the future vesting, and now it's suddenly go drop by half, right? So they definitely will feel that the future income is lower. That's definitely going to impact into their decision making today. And the other alternative is financing also more expensive. So I do think that it's going to impact. It's just to what extent.
Gotcha. And then Aaron, I think maybe that's an interesting part is I'm going to say I really love the point you brought up, which is, if you look into your stock account, things are going great. Maybe you're like, okay, purchase the home. And maybe you can still purchase it with stocks down 40%. But I'm curious if you had the experience, maybe similar to what I've had, where, they talk about the wealth effect, maybe where when people's stocks are down or other assets, do you find that feeds into people's level of caution about purchasing or making those sort of big decisions?
I think that's the reason why the lesser priced homes, they're being affected by rising interest rates. Obviously, people generally buy within that range based on their capacity to buy. So a lot of that is based on a monthly budget. So, I mean, it's on a couple $1 million home, a jump from 2.5 to almost 6%. That's a large jump in monthly expenses. But those who are, again, buying homes that are 3 million plus, they've had the resources. They have the resources now. They've had the resources before this market downturn, and they're willing and capable of putting more money down, of financing less, and buying these more expensive homes, which is why they're not really affected, at least in this current environment. Like you said, Adam, real estate is a lagging indicator. So as with most illiquid assets, where generally real estate, it's somewhat correlated to the stock market, but it definitely takes some time for prices to come down.
Yeah, Aaron, you were saying, we've got this historically fast turnover, let's say 2 weeks. I can sell a stock in 30 seconds. I can log into my account right now and it'll settle in 2 days. So it's a good point. Any market that has more friction, it generally takes a longer time for prices to read in or factors to read in. People have already made plans. They're maybe already under contract. So it does take a while for these things to read in.
Yeah, and people who are looking for a house in January probably still looking for a house. So the plan might have been put in play in January.
There's one of those, and I think that's one of the things that we'll probably talk about when we get into is there's just life circumstances, right? If you're in a cramped place and maybe you have a child or you have a second child, you're still looking at home if you have to pay a little more. So there's the factor too of we kind of tend to think about real estate purchases as kind of discretionary, where maybe they are, but you could also argue, if you need a home, you need a home. So, and there's a reason that people are still buying here.
Or a third child in my case. So
Or a
yes.
third child. There you go. Exactly. Or twins and a third child. Exactly. But
I would say that most of this presentation, it's based on historical data and present data, which I think is enormously important as just setting context to the conversation. There are just so many qualitative reasons for buying a home, especially here in the Bay Area, which I think we're gonna get into
yeah.
further in the conversation.
Yeah, and if we don't mind moving on, let's take a look at the next slide. I thought this was just an interesting to put it in very historical context. We definitely do not want this to be about Summitry just shows you charts all day, but I think it would be helpful to just kind of see some perspective. So this chart just looks at a very, very long-term look at home prices in the United States going back to 1890. I want to be very clear, especially if there's anybody who works in data science or statistics on this call. Anything that goes back that far is obviously an estimate, right? We're working with rough numbers going that far back, but we can make estimates about what the long-term trend looks like, right? So we can kind of glean some data from that. So this looks at home prices divided by the consumer price index. So you could think about this as the real price on homes, so the growth that happens above and beyond inflation. And what we saw was kind of peaking in the late 1890s and going all the way to 2000. There was obviously a drop and it came back, but real home prices really didn't change much for 110 years. Again, taking this with a grain of salt, but even if we're looking back towards, the 1930s, we have pretty good, robust data from back then. And so most of the real home price growth, again, real being above and beyond inflation, has come in the last 20 or so years. And I think that actually, Aaron really brought up a good point. Even if we look at it on a smaller time scale, a lot of the growth has come since 2000. The 1990s were, at least the early 90s, were not a terribly great time for Bay Area real estate or real estate in general. The takeaway I don't want anyone to have from this chart, and maybe Mandy and Aaron, we're maybe in the same boat here, is we're not predicting a housing bubble. We're not predicting a housing crash. We're not saying don't go out and buy a home. But I think sometimes it is important to keep the perspective that a lot of the appreciation in home prices, and again, this is looking nationally, we don't have specific Bay Area data going back this far, but a lot of the real growth has come in the last 20 years. And so we shouldn't take that for granted, is the way to think about it. It's a gift. It may not continue. It may, we really have no idea and we wouldn't want to guess, but it does put in perspective just how really astronomical and wealth creating the growth has been really in just the last 20 years. I don't know, Mandy, Aaron, how do you think about that? And, the historical, like if I look at this chart, my first thought is, oh no, it's going to go back down. How do you think about those decisions when someone looks at a chart and they go, oh no, real estate's at an all-time high? How do you think about that? Because there's this temptation to just not do anything. And I don't want to be the sucker who buys at the top. Like how do you think about that when you see a chart that says, oh no, real home price growth is all coming in the last 20 years. It's all going to come crashing down. How do you think about that?
Well, I think coming back to what we always tell clients about not timing the market, and this also another incident of not timing, right? It's about if you're going to stay by this house, it's going to be the house that you want to stay in for a longer period of time, then that's a very different decision than there have been a pattern of, well, how price going to goes up anyway. I'm just going to buy this temporary house that I'm not really love, and the price going to increase. I'm going to change the house, say, in 3 years. I don't think that we can take that for granted anymore. Maybe in 3 years, you're not in the up for the house, and there might be difficult to upside or changing. But then if this is the house that you really want, this is the house that you feel like you're going to stay in for a long time, then by all means. I just don't think that we can take for granted that next year my house price is going to be higher than the purchase price.
Yeah, I think that's an excellent point, Mandy. And there's such a big difference between buying a residential property for you and your family and for quality of life versus buying an investment property. And just looking at historical numbers, if you buy a rental property in the Bay Area, you're really buying it for appreciation. The return on
Yes.
investment from a cash flow standpoint is one of the worst ROIs in the entire nation. You're buying it for appreciation. But if it's going to be your forever home and it's going to increase your quality of life and you have the capability to purchase your dream home, there's a lot more important things, I think, than just the quantitative data in purchasing a home.
Yeah, and coming back to one of your point earlier, Aaron, like there's the last couple of years, a lot of people buying house without any contingency. There might be problem with the house. They just want to buy any house.
They went to outbid the other 6 bidders. Yes.
Yeah, I don't think we, if that's the case, then maybe have a pause.
Yeah, I think it's, you guys bring up a really good point, and I'll only cap this with kind of a quick story that one of our colleagues shared as we were preparing for this webinar. Shared was purchasing his home in 2006 and said, I know this is expensive. I know this is, but was not planning in 5 years, I'm going to flip it, or if I don't like it, I'm just going to move. Says, you know what, this is my forever home. This is where I want to be. I love this place. This is exactly what I need. And I know I can afford the mortgage. I know I can afford the property taxes. And, I think I would argue that it took a couple years, but it was arguably a good decision in terms of, understanding that you can't time everything perfectly. It's more about the decisions that you make. And maybe that's a good segue into Mandy. How do we think about these decisions, right? We can talk about where we are and where we've been, but it really doesn't matter, because what most people care about is, okay, so what am I supposed to do? Whether I'm buying a house, I'm upsizing, I'm selling, I'm moving. And if we could maybe go forward one slide, Mandy, maybe you could talk to us a little bit about how people should make decisions in a rising interest rate environment or just an uncertain environment, which is, I think, maybe where all of us feel a little bit like where we are right now.
Yeah, so all of us know that interest rates have been rising, but I still want to put this chart in to see how shockingly fast it have increased. I think, as I mentioned earlier, in this brutal market environment, somebody who looked for a house 3 months ago, still looking for a house. And unfortunately, the costs have been significantly different today compared to 3 months ago. And if you can move to the next slide, just for this purpose, like let's say you're not buying an old cash offer. Let's say you're gonna have a million mortgage, which consider the prices around here. A million we see $1, $2, $3 million mortgage that our client carry. This is not a one-off case. This is the norm. The monthly payment at 3%, which is, as I say, at the beginning of the year, this is what we plan for, is about $4,000 a month. And today, the same 1 million mortgage is over 40% higher. Now, for most of our clients, they already have a home. So I'm talking more, say, consider somebody who wants to upsize. The pandemic, staying at home more, want a bigger yard, growing family. There is many good reasons to upsize, but let's say somebody who consider have a $2 million house and now want a bigger play at 3 million. The mortgage, a million mortgage at 3% compared to a $2 million mortgage at 6%. You're talking about from 4,000 impact in cash flow to 12,000 impact, the 3 times different compared to what originally planned, only double. Like that can be a very significant impact on monthly cash flow. So in the Bay Area, in California, Prop 13, the fix in property tax already have put in a big hurdle into status quo. You're much better off staying in your current home compared to buying a new place and get a step up in property tax. Now with this, keeping the lower interest mortgage on your current home compared to buying a new house and suddenly paying the same mortgage, but suddenly a lot more expensive. I think it's gonna make the status quo look better, much better. Switching costs become higher. Now I have a couple of conversations with clients who are thinking about purchasing a new place. We started talking about what can we do, what kind of improvement we can do at the current place to make it a better place for you to live compared to the significant cash flow that we're going to have to pay by purchasing a new place. With that said, there's still many clients, it's make a lot of sense for them to move for various different reasons. It's just we have to put more contingency. We have to stress test it more, make sure that cash flow works. And with the possibility of recessions become more real these days, we want to make sure that what if you out of a job for a few months, we want to make sure that you have a good enough emergency plan, emergency fund to cover these type of scenario. On a positive note, as I say many times, maybe it's not as much of an emotional roller coaster. The process of purchasing a home may not be as much of an emotional roller coaster as it was before. The reality is we're not building more houses and millennials still buying houses. So I don't think it's going to be significant drop anytime soon. But again, you need to look at your plan, you need to make sure that it works. You don't want to just continue with the plan just because you have it in place 3 months ago. It's important to relook at the plan. And with investment properties or about return on investment, and now the cost is more, and I don't think the rent gonna increase as much to keep up with the cost, especially again, you are a landlord, and if we're gonna be in an economic downturn, you have to think about vacancy. You have to think about what if your tenant cannot pay for periods of time, or those things need to be factored in this more challenging economic environment.
Yeah,
I think that's a
yeah. Go ahead, Aaron,
Sorry.
please.
I think that's a great point, Mandy, in purchasing a home. Just the consistency of your income.
Mm-hmm.
It's much different to purchase a home with W-2 and maybe some equity compensation that is relatively consistent as far as base, maybe bonus. Your equity will fluctuate, but the stability is there. If you have a job like a mortgage broker or a realtor or something where your income's variable, it's really important to keep enough in a bank account that's not subject to market volatility, just in case of emergencies or in case you have a bad month or a bad quarter. I also think, Mandy, just looking at the mortgage rates, looking at it from just a tax standpoint as well, mortgage rates are high. They're 6%. If you purchase a new home now, interest can be deductible on Schedule A if you're itemizing deductions. So if you're in the highest tax bracket, you're paying 50.3% tax on every dollar you earn. So the 6% could be much lower from an after-tax basis. So just from an income standpoint, it's not what you make, it's what you get to keep, and also from an expense standpoint, you need to look at things from an after-tax standpoint. So if you're in your highest income years, that net interest could be a lot lower than, say, you're getting ready to retire with very little earned income.
Well, and talking about that, the sad reality of the Bay Area is you're likely to have a $1.52 billion mortgage, and only 750 of a new mortgage can be deductible. With interest rate become so high, it might worth looking at alternative way to get some of the additional interest get deductible on top of the 750. But that's for another day.
Yeah, I think that's a really good point, though, is things like deductibility, the tax impact of mortgages. For those interested, we could probably do a whole webinar just on that. And I could ask about 100 different questions just to kind of follow up on that. But I can't think of a better way to transition to maybe the Q&A portion of our webinar, where we want to go a little bit deeper. And thank you both of you for putting together those slides, just to give us something, a little bit of context to discuss. But I've got some questions for you, but we've received a lot of questions from clients, people attending as well, just things that they want to know. I'd encourage anyone, if you're interested, please feel free to throw a question in the Q&A section. We'll do our best to answer them live, and or if there's anything that's specific, we might say, this is maybe a great question to bring up with your financial advisor. If we're not able to get to any questions, we will do our absolute best to follow up with them. We're going to read some of the questions we received beforehand. But again, if there's something we can't get to, please follow up with your financial advisor. We'll follow up with you, but want to make sure that your question is answered. So I think I got to respect the absolute first question that we received from a client. And I think it was 30 seconds after we sent out this webinar. So I know it's very top of mind for them and I want to make sure we answer it. So the number one question, or I guess this is the first question we received, is what perspective or thoughts or things can I think about? And maybe Aaron, I'll open this one up to you. Helping children purchase, right? Because you got your home here. Mandy talked a little bit about the millennials, and now everybody's millennials are having kids and, buying houses and stuff like that. So maybe my kid went to school, they're coming back home. What things should I be thinking about? How might I be able to help them if that's something that I have the means to be able to do?
There are so many nuances that come with that question, both from just the financial and also just a family dynamic standpoint. From a financial standpoint, you need to make sure that it's not considered a gift. So if you just give your child a house, the dollar amount above the tax will be considered a gift, and it could be taxed at the estate level when that time does come. So there are ways to give your child a house and basically be the lender for that home. It's complicated. You need an attorney to draft up the documentation. The benefits of that are that your child pays a lower interest rate, much lower than what you would find at a bank. Also, if it's done correctly, the child can deduct that interest on their tax return as well going forward.
Gotcha.
There's probably more cons to it than pros. There's the family dynamic. So if your child doesn't pay you the mortgage, then it can cause severe rifts within the family. And I've seen it in the past personally. It's kind of like, the estate, the whole estate, just family and money sometimes turns into a disastrous combination, at least in my experience. It's not like you can go to a credit reporting agency and ding their credit. Neither would you want to being their parent. But there are legal ways to do it, and we have some attorneys that could help, and we could guide anyone who's interested in making that decision.
Got it. That's great, Aaron. I think that's the point is, right, there's two aspects. There's the how do we do this tax efficiently, and from a financial planning standpoint, as I think you brought up, there's a high degree of nuance there, and it's definitely a longer conversation. But there's also, when have you ever heard about family and money? Family and money? It's never been a problem before, I'm sure, in any issue. So I think that's an important, and that's so qualitative, right? That's not, no two families are the same, no two people feel the same way about that. So really love your insight there.
When a client asks me if this is a viable option, the first question that I have is, how do you feel how that would impact your financial plan if this doesn't get paid off? Can you afford to not having this pay off? How do you feel about the relationship with your children if this, for whatever reason, get paused or not pay off for a while? Because mom and dad bank is always considered the most flexible loan.
Yeah.
So it can have a serious implication on our client who might be a retiree already and doesn't have the ability to earn more money. That might have a significant impact on their own retirement plan.
Yeah, Mandy, I think that's a good point. You shouldn't be a mortgage lender if you can't, right? All mortgage lenders know that they're going to not have to pay, but all they have to do is a legal process where there's a lot more nuance that it comes in when there's family involved. Great. Thank you guys so much. Yo, go ahead.
Mandy having a husband who is an estate planning attorney probably knows all about family and money disasters, and she could probably share some stories on a different webinar.
Yeah, I think that's a good, right? We've all unfortunately seen when it goes wrong, and I'm sure everybody has a story, but unfortunately, we've probably got 100 of them that we could share. So, Mandy, this is a little bit of a pivot, but I find one question that came up, and one question that we're getting more from clients is, should I consider an adjustable rate mortgage? They, in many cases, might have a lower initial rate, but I think everyone knows there's no free lunch, right? You don't just get a free lower rate. So I guess the question is kind of in two parts is, one, does an adjustable rate mortgage make sense? I know that's a very broad question, but also two, like, what are the pros, cons, things that I might want to think about if I'm considering an adjustable rate mortgage to make a purchase?
Yeah, well, the first thing I would ask is, why do you consider an adjustable rate? Is that you can only afford the monthly payment with the lower adjustable rate, right? If that's the case, then it doesn't make sense. If you can pay the 6,000 monthly payment, and with the adjustable rate, the payment is like $1,000 less, it shouldn't be a reason why you consider adjustable rate, because it's we don't know when the term get refinanced. Can you afford it at that point? Now, if you gonna only stay in this home for 5 to 7 years, and you're planning to go somewhere else, then that's obviously a good reason too. Or you have the financial means to pay it off if the risk is significantly higher in, say, in 5 or 7 years. Then this also, you should consider the adjustable rate. And if the worst case scenario happen and the rate is significantly higher at that point, then we figure out a way to pay it off. But if you in a less, if you need the lower rate in order to meet the standard payment, then I would not consider that.
If you're gonna, so basically what you're saying, Mandy, is if you need that lower interest rate to be able to afford the monthly payment, it doesn't make sense.
It means you can't afford the house.
Yeah, I mean, that's what it means, right? Is you can't afford the house. Now, it does mean, though, if you're going to use it tactically, maybe you have a pay down strategy, you want the optionality on the interest rate, there's a lot of planning opportunities there. So you shouldn't just write it off, but we should be very clear about why we're doing the adjustable rate mortgage, not just saying, well, it has a lower initial rate. Not saying this now, but that's what got people in the trouble in the mid 2000s was, oh, the low initial interest rate's really low. Again, it's about the total payment that you're going to make over the life of the mortgage.
There's also, there's also, yes, interest rate, but so many clients that I speak with, they want to pay more on their principal loan. So I would say that there's kind of the financial answer, and then there's the answer that just feels good to you. I know my father, he would go crazy if he drove in his driveway and knew that he owed $1 on his home. And many people feel like that. It just makes them feel better. It may not necessarily be the best financial answer, but it's the best answer for you. Now, I would say that it was a lot easier when interest rates were 2 3/4%, opposed to around 6% where they are now. But there's always that other aspect that you need to be comfortable with as far as just how you feel taking on debt.
Isn't this why it's so hard, guys? This is the hardest decision because there's such a confluence of emotion, and I don't mean that in a negative way. How can you not be emotionally attached to, especially a place where you live, a primary residence? But there's such an important, this is also the biggest purchase or purchases that people will often make in their lifetimes. And so it's such an important financial consideration mixed with such an important emotional, qualitative, there's a lot that goes into it. So, kind of on that vein, Aaron, you alluded to this a little bit, so maybe I can kick this one back to you. But you were talking about the idea of a rental property, and we also talked a little bit about primary residences. Tell me about this. Those are such different considerations. What sort of things might I think about? And I guess we could think about it either way, but what sort of things might be relevant for an investment property, or that I think about that I might think differently if I was purchasing my primary residence? Are they exactly the same? What are some factors that, I don't know, might help me make that decision if I'm purchasing either one of those or potentially both? I don't know.
Well, if you're looking for an investment property, and I own 3 investment properties, and 2 have worked out really well, and 1 has been a complete nightmare. So you have to think about how how you feel about being a landlord and the potential problems that can come up, whether you want to hire property management companies, whether you want to take a loan out in your own name. There's this wide spectrum of investing in real estate. There are, from the easiest, most liquid, there are real estate ETFs that trade, just like you said, Adam, like stocks on the market. And then there's you taking out, an investment property in your name, buying an either single, multifamily unit, finding the tenants, doing all the screening, taking care of all the repairs, the costs, all of that. And then there's this myriad of things in between where you can own real estate, receive some of the benefits through depreciation and things like that, but not have to be personally liable for that property. So there's a whole spectrum of different ways to invest in real estate. I would say for an investment, you're really looking at it from either or both a capital appreciation or a cash flow standpoint. And like I said before, in the Bay Area, from cash flow standpoint, this is not a good area to invest in real estate. If you think that the home will appreciate as it's done over the past couple of years, it could be a decent investment. But the first decision is, where do you want to buy? The second is, how do you want the ownership to be structured? Well, whether you're just a limited partner in apartment building or multiple apartment buildings, or whether you want to actually be a landlord, property manager, deal with all the hassles that come with managing a property. For a home, it's really, there are so many things that come into buying a home. If you have kids, like I do, it's the school district. Whether you want to live in a really expensive area and have your kids go to a good public school, or whether you want to live in a less desirable school district and maybe send your kids to private school, which can be, 30 to 40,000 a year. There's the commute time to your office, and things have definitely changed post-pandemic, where many companies are either, virtual or a hybrid approach where you're only in the office a couple days a week. But one of my clients, he works at Google. He just bought a house in Livermore, and he goes to Mountain View 2 days a week, and he's willing to kind of deal with that commute in order to buy a nicer $1.8 million home in Livermore, which he would not be able to afford in Foster City or San Mateo or anywhere in this area.
That's a good point, Aaron, is the changing world gives us different opportunities, and it's all about trade-offs. How important. I hate commutes. My one rule, I try to live within 15 minutes of work, but for some people, especially if you're working remotely 3, 4, 5 days a week, that's maybe no longer a constraint. But there's, I think as you bring up, Aaron, it's very much dollars and cents when it comes to investment property. It's all about ROI and IRR and cap rates. There's a lot more that comes into, how much do I care about a commute versus my kids having a backyard? I mean, there's all sorts of things that go into it. So we are getting some live questions in the Q&A, so I want to make sure that we have a little bit of time to answer those. Mandy, it looks like this question is actually directed towards you, so I'm gonna kind of direct this in your question. Does it make sense? And I think this is especially is directed towards kind of seniors, but maybe this is, I think, a good general question. Does it make sense to start paying down a loan faster, maybe paying additional principal? And then it looks like, if I'm interpreting this correctly, considering refinancing. So maybe, how do you think about the idea, and Mandy first, and then Aaron, if you want to jump in, about the idea of paying down extra principal? Does it make sense? Does it not make sense? And I'll stop talking. I'd love to hear from you too.
So first is where you're starting. If you have, unfortunately, many of our clients who already have a home, we definitely talk about refinancing with them over the last couple of years when we have very low interest rates. If you are one of the people, and if your rate is very low, then absolutely there's not, unless you just really don't like carrying a big debt, there's a lot of good financial reasons to keep the loan. Now, if you have an adjustable mortgage that up to refinancing, and you have the option to have an ARM or a 30-year fix, and you thinking about having an ARM and paying additional principal, and then to refinance in the future, then it's a very different questions. Now, when you have an arm, you're pretty much betting on interest rates staying the same or lower when the time's up, which we don't know is the option that you buy, that we're going to pay a lower rate in this year. The risk that you take is interest rate might be significantly higher in 5 years or 7 years. If this is a question that posed to me 6 months, 9 months ago when interest rate is record low, I would say absolutely lock in the low rate as opposed to have an arm. At this point, when interest rate is already higher, and you can afford, say if interest rate raise a couple more % in 5 years, and you can afford that future payment, then it's my worth looking at taking the risk of having an arm now and betting for the fact that interest rate might be the same or lower. Assuming your balance sheet and your cash flow allow for the monthly payment if the rate is higher, meaning you can afford to take that risk.
That's a good, yeah. I was just going to say, Mandy, if you're pulling from the portfolio to pay down when the market's down, like maybe does that make, but again, it's like if we have extra cash flow, maybe it's a Social Security pension or just income, it's a different calculation because it's more about capital allocation.
Yeah, Aaron, and it's about the alternative that you have for the cash, right? If it is pulling from the portfolio when it's already go down, then it might not be, or it would be a different answer compared to if you have a significant cash balance and your bank only pay, I think they pay 1% now. Yeah. Then that's a very different equation.
Yeah, absolutely. Aaron, I'm sure you'd probably have something to jump in here, but I want to address maybe one more question so we can get to the Q&A, and I'm going to kick it over to you, and no pressure, but I think it's a pretty tough one and might ask us to speculate a little bit. So just to kind of summarize the thrust of this question, we looked at a lot of things right now and where the market is and what the market has done and some historical relationships. And I know we talked about some timeless principles of financial planning, but given everything that's changed in the world, we talk about these large equity compensation grants, maybe more access to financial markets in general. How do you think about, do these relationships still hold? Has everything that's happened in technology over the last 20 years just so fundamentally changed the game? And how do you think about those sort of things? Like I'll call it this time it's different, and I'm putting it in quotes because sometimes it is and sometimes it isn't. But how do you think about is this time different question? No pressure or anything.
Yeah, no, you've definitely put me on the spot here, Adam. Thank you. I would say, living on the East Coast for most of my life and then moving to the Bay Area in 2016, there's a much higher correlation here with real estate in the stock market because there's so many high-tech employees and they can afford more house when the market's doing well. It's not necessarily that prolific over on the East Coast where it's not so much of people's compensation is not tied to their company stock. And again, it depends whether you're looking at the property as an investment or for your forever home. I mean, buying an investment for cash flow, there are so many better places in the US to invest in from a cash flow standpoint. I think I read something like a CapEx number, and typically it's 5 to 7x what your return should be from a cash flow standpoint in a relatively normal market. And I wouldn't consider the Bay Area to be relatively normal, especially today.
Aaron, I think you bring up the good point, which is historical relay, right? This is a different place. We're not saying things are different. It's not the same in Boston as it is in here or Baltimore, or, insert city here. But I think one of the takeaways is, and hopefully if we can hammer in, there are some things that are timeless, like how to make good decisions around real estate purchases, how to avoid getting in over your head, how interest rates affect prices over time. Some things are timeless and some things change. So I think our job is to focus on, if I could put a little bit of a cap on it, the things we can't control, and then understand that and be humble that things change and there are things we can't control, but knowing what is within our power and what's without our power and focusing on the things that we can change. I don't know if that was a satisfactory answer to that question, but hopefully we started to scratch the surface, and I know we covered a lot of important topics today. Thank you so much. We've come up on our time, and I've taken 2 extra minutes of your time. So a huge thank you to all of us for joining today. You've got a lot of choices as to how to spend your time, and we appreciate you spending it with us. We hope you found it valuable. If it inspired some questions, please talk to your financial advisor. And big thank you to Aaron and Mandy for their wonderful work as panelists. I always enjoy talking with them. And Anne, who hasn't had the chance much to speak because these things would not happen without her. Thank you so much, everyone, and have a wonderful day. Pleasure seeing you. Bye-bye.
Thanks, everyone.